In our last couple of videos, we had completed up to the end of January 31st, 2025, and kind of got to this trial balance outlining a financial snapshot of where Jenn is. But one thing we did kind of put a question mark around was this investment of $400 right here on our bank statement, talking about putting $400 towards some investment. And we weren't really quite sure what that was to do with. And today we're going to pull the curtain back and actually get a glimpse into Jenn's investing. And we're going to talk about a very underutilized financial savings tool in Canada. And this is the Registered Disability Savings Plan. So to begin our discussion today, I have a few more client notes about our favorite client, Jenn. So in 2018, Jenn lost her hearing due to a swimming-related head injury. She does use hearing aids, but she has difficulty hearing. She learned about the disability tax credit in 2021, and as a result of information provided by her doctor on the application form, she's now eligible for the tax credit. So starting from 2018, even though she got approved in 2021 because of the severity of her hearing loss. And the next one is, since she got approved for the DTC, she immediately opened up this Registered Disability Savings Plan. So a few things to crack open. First thing I wanted to talk about is this, some of this information here. And this is all public info, so you can find it on the government websites. What is the disability tax credit? So this is essentially a tax credit aimed at helping folks with a physical or mental impairment. And there's two big components to it, and we're going to be talking about one of them today. One is the tax credit itself, which we'll talk about in a later video when we actually do Jenn's 2025 income tax return. But the next is this Registered Disability Savings Plan. So that is where today's discussion will lie. Firstly, how do we get this credit? Because you can't start this disability savings plan without getting the credit yourself. So how do we find out who is eligible? Right, so looking at here, who is eligible, essentially you have to have a severe and prolonged impairment, and you need to demonstrate that you are markedly restricted in a particular category. So there's lots of different categories here you can look through. We're not going to go through all of them. We're just going to go looking at this hearing thing, and then it kind of talks about some of the conditions you need, right? And it essentially comes down to, does it take you 3 times or longer than a regular person of your age to do this particular thing? And there's even an example here, which is not too different from our example of Jenn, talking about this person named Kevin, who is also approved for the DTC because of hearing loss. Okay, so if you can get approved for this disability tax credit, you're going to have to eventually submit this form called the T2201. This is completed by you and your doctor, so it's pretty much you find the section that you're, the category that you're struggling in, or you have the disability in, and you're going to be filling out these sections, and it's going to be completed by a doctor or medical professional. So sort of a high level there. Okay, so if you are eligible for the disability tax credit, you can open up a Registered Disability Savings Plan. Well, there's a few conditions here. One of them is the age. So you cannot do so if you are above the age of 59. So in Jenn's case, this is fine because we've finally learned how old she is. I think in this next tab here, we talk about her birth year is 1999. So she is in fact a Gen Z. Gen Z is Gen Z. So in the year 2025, which is where we're at, she is going to be 26 years old. So she has plenty of time to put money towards this account and so forth. Okay, so what's so special about this account? Because it's sort of like, we've probably heard of the basics of RRSP, TFSA, and it's kind of similar to the tax-free savings account, but there's some really nice extras here. And this is kind of puts it, I think, really above the TFSA in terms of long-term savings and growth. Because you get these, the Disability Savings Grant and the Disability Savings Bond, right? So What are these? These are essentially matches from the government towards your disability savings plan. So if you put money into your disability account, the government will actually match. And for the grant, they do a matching. And for the bond, I think they just give it to you. You don't even have to pay in yourself. It says no contributions have to be made to get the bond. So let's start off with the grant, and we'll see how this affects Jenn's situation. I'm going to be keeping it relatively simplified here so we can really drive our narrative through. Essentially, it's based off income, right? So depending on your income, if your income in 2025, that is, and if it's below $14,750, then you can get up to a maximum of $3,500 per year. If your income exceeds that amount, then it really goes down to this $1,000 per year is the highest that you're going to be able to get. And this is indexed each year. I even have this kind of sheet here that talks about all of the previous years. It doesn't really increase by a lot, but you can see the most we have now is 2025. There's these phase out, first threshold, second threshold, which we'll talk about in just a moment. Okay, so the grant you get, they do a matching, right? So you have to put in a certain amount, right? You have to put in at least 500 and 1,000. So you have to put in at least 1,500. And if your income is below this second threshold here, you will receive the full 3,500 per year. And then anything beyond, you're just going to get that 1,000. Moving on to the bond. So the bond automatically comes in if your income is low, below 37,000 or so. So that's where this is this phase out income, first threshold, second threshold. If your income is between those amounts, then you're going to get a portion of this bond, you know, it sort of gets grinded down to that. This first threshold number is anything, if your income is above this, then you get nothing. And note this is based off family net income, which typically applies for folks that are under the age of 18, as mentioned here. But for Jenn, she is above the age at the time of this, so we really only have to worry about her income. All right, so the nice thing also is there's this carry forward of unused grant and bond. And this is great because this means that if you had a disability in a previous year, but you didn't learn about the tax credit until later on, you can actually go back and up to 10 years actually and get those, receive those grants and bonds for those years in the past, which is exactly what happened to Jenn. They have a few maximums here. So they're saying, okay, the most you can receive per year in catch-up periods for the grant is $10,500, which would be 3 years of the max 3,500. And then the most you can get for the bond is 11,000. So that would be a full 10 years backdated and then the current year. So Jenn didn't have the disability for that long. So we're just going to flip over to some facts here of kind of sample data, and this can actually align with where we are today, which is in 2025. But let's take a look at what happened and kind of just walk through line by line before adjusting some of the dynamics here. Okay, so Jenn found out, or not found out, unfortunately Jenn had the accident in 2017 and now had the hearing loss. So she was eligible for this credit starting in this year, but she didn't learn about it because this credit's not, you know, it's not well advertised in our country. So sometimes you find out about it a bit later. Sometimes, in Jenn's case, it was only 3 years, but hopefully you're not finding out about it too late. So she opens it up, and at this age, so she's 22, and her income is about 30,000. We're just gonna have kind of approximate income for these. So she was a student for this period, and then kind of the narrative goes, she started working a bit, and then, you know, maybe discovers ways to make more money down the road, which we'll get to in time. But for now, let's go back in time to 2021. So Jenn earns $30,000 a year. So she is below, if we just flip back to these thresholds here, right? She is below even the phase out income, meaning she's eligible for both the grant and the full amount of the grant and the bond, right? And she's putting in a flat $4,800. And I know we're saying she contributes this monthly, but to simplify things, we're just gonna assume that this contribution happens at the beginning of the year. and then the matching happens also on that same day. In practice, this might be a little bit off. Usually the grants and the bonds come to like 6 to 8 weeks after, but we can just simplify for the calculation. So, these aren't going to be dollar for dollar accuracy, but it will definitely paint a general outline for you to see. So she puts in $4,800, which is $400 a month. Then what happens is she gets that full annual maximum, right? Because she gets to go back for 2018, so 2018, 2019, and 2020. And she doesn't even get to claim 2021 this year because she gets stopped by that maximum of $10,500. So the government gives her this money, automatically sends to her. And the government also gives her the bond, which is under the annual maximum of $11,000. She gets it for 2018, 19, 20, and also for the current year, which is where that $4,000 is coming from. So $19,300 goes into the account, even though Jenn only put in $4,800 herself. And at the beginning here, because when you have any of these registered savings accounts in Canada, the same applies for TFSA, RRSP, RESP, and so forth. You can use them as an investment vehicle. So what does that actually mean? It means you can invest in qualified investments, and you really should. Otherwise, you're missing out on potential investment income on the table, right? In a common way, and I'm not going to tell you what type of investments to buy, but I can give you a general idea, right? There's lots of options, right? Qualified investments are typically under the following. Some of the big ones you might have heard about, GICs, are usually lower rate but very stable. And then there's things like mutual funds, or even you've probably heard about ETFs, right? And for a longer term investment strategy, since Jenn is, using this savings plan for many, many years, I would probably think that she'd go for more of the longer, bigger growth. So potentially a mutual fund or a ETF, right? But for now, we're going to assume it's a 0%, right? So what happens over the years with the 0%, and then we'll play around with the different inputs here. Okay, so the next year, so now she starts off with this. She puts in another $4,800. The grant kicks in again. The grant is only going to be for the previous year because we didn't get the last year's unused of 2021, and also the current year of 2022. So we get $7,000 in the grant and $1,000 in the bond. So the government contributes $8,000, bringing us $12K up to $32,000. So then there's some changes. Jenn's income increases to $60,000 because now she's done her university and now she is working, right? So income has gone up. Maybe she has a few sources of income starting in 2023. So the contribution stays the same. The grant stays the same. Now it goes down to the annual maximum because Jenn has used up all of her previous unused room. So she's just going to get the $3,500 going forward. But the bond no longer applies because she is now past the first threshold income. So she no longer gets that $1,000. And that's good. So next year is, I think, pretty much the same, and we'll jump ahead to 2027 where things really start cooking for Jenn. So she's now earning, $125,000 or thereabouts. So she's now past the second threshold, which means the grant doesn't disappear, but it gets grinded down to a maximum of $1,000 per year, right? So then this keeps happening until the year she turns 49, which is 2048. And then she's no longer able to contribute. She's no longer able to get either the grants or the bonds. Doesn't matter what her income is. Okay, so the last couple of things is the lifetime amounts, right? So you can contribute yourself up to $200,000 into an RDSP over your lifetime. So under this model, Jenn actually has $65,000 of leftover room. So she could actually increase this a little bit, right? And we'll do so a little bit, play around with a few scenarios just for fun in a bit. Also the grant, so you can get up to $70,000 of the grants. Jenn only received 53. For her to get this unused amount, she would have to have lower income, right? Because after this year, she's getting the benefit of higher income, That's why she's not getting the full grant. So maybe later in life, if the income dips, she could go back to earning that $3,500, which would be great. Then we have the bond. She only received $5,000. There's the maximum of $20,000. So this means you can get up to $90,000 from the federal government, depending on your income. And since Jenn started earning more income, she wasn't able to get all of that, but I think it's useful to know. Okay, so let's make this more interesting now. So let's say, of course, Jenn wants to pick an investment that's better than 0%, because with 0%, your money is not working for you. You end up with $192,000. But let's say Jenn finds an investment that gives her an average 7% return. How does this change? Well, obviously now, each year she's getting annual growth, and she has lots of time working for her. So you can see her financial picture is radically different. In fact, she is having over $1 million in her bank account by age, or this is just not bank account, this is her RDSP only by the age of 55. And this would continue to grow, and that age 59, 60 is kind of the magic number for your RDSP, which is where you have to start taking money from it. And we'll talk a little bit about withdrawals in the future, maybe in a part 2 video or such, but the taxation isn't too bad. It's not as good when you withdraw as you compare it to, say, a TFSA, but it's still pretty solid, especially if you can sprinkle this over a long period of time. The tax consequences won't be brutal. The deferral you get from using this is so valuable, so you don't really have to worry too much about this. But like I said, we'll talk about what happens when you withdraw this money and when you should withdraw it in a future video. Okay, so let's say, all right, so Jenn has unused contribution room. So let's say she instead wants to max out her $200,000. So we can find the amount of $627.77. And I think this gets her, yeah, almost to the exact $200,000. If she does this approach, she's having to fork out, $600 a month or a little bit extra. It gets her to the final $200,000, and now she has $1.2 million in the bank, right? And maybe you think this 7% is too high or too low. We can play around with it a bit, right? Maybe you are a strong investor and you can get 10% on average long term, and maybe you could do this if you use, a strong mutual fund or ETF. In this case, where do we end up at that same age? Oh, 2.6 million. That's quite a bit, right? Maybe we think only 5%, and we'll go back to that $400 because that's all we can muster per month, right? In that case, we still have, right? It's still pretty solid if you look at, and I have a bit of a line chart here we can kind of look at and kind of see, okay, so how do we get this money working for us, right? So let's put the 0. You can see the relationship is linear, right? These are just straight lines depending on the bond, and then we stop altogether, capping at just under 200,000. But when we filter these around a bit, it's even 5%, right? You can see this this curve starts to angle up a little bit more exponential, getting us to around 800K. If we can get 7%, it's even higher and steeper at 1.4 million by the time you're 60. If we can get a larger contribution, let's say $600 a month, and let's say 10%, we can get even more, right? And obviously this is now getting into the land of super fiction, but let's say we can do a 15% at $600, right? You are having, this is $16 million if you can pull that one off. But obviously that's not super realistic. I do think the 7% is somewhat realistic, so that will give you a ballpark. So maybe we'll stop here, leaving us back to where we were. Okay, so what does this mean at the end of the day? Well, it means that Jenn should definitely continue putting her money towards this RDSP account while she has, still having room in the grant and the bond. And how does this fit into our kind of last couple of videos? Well, if we wanted to take her think about this as a personal journal entry to true up her balances, because right now we're just still in January 2025, so we're back in the past. But we can look at her investments here, and we can say at the end of 2024, the value of her investment, let's assume she has the 7% at $400 per month since inception. And this doesn't have to be her, right? This could be also family members helping contribute for her if she didn't have the $400 a month when she initially set it up. Anyways, she has $59,363. So this would be kind of added to our true ups entries, right? We would take the date of 2024, December 31st. We would debit the investment. So this investment's now going to be around almost $60,000. And we're going to credit capital, right? So in the next video, you're going to see those factored in. So we now have a fuller understanding of Jenn's current investment situation. Okay, so that wraps it up for this video. We talked about the RDSP. We talked a little bit about the disability tax credit, and hoping to do a little bit more on this in the future when we file Jenn's actual income tax return. Otherwise, see you in the next one.